Good morning, and thank you for taking the time to join us today. My name is Rebecca Cook. I'm an associate and head of Vickery Holman's Truro office. Today, we will be discussing the all-important matter of business rates, with the aim of answering any questions you may have about the end of the 2017 rating list and the beginning of the new 2023 list. I'm delighted to introduce my colleague and head of our business rates consultancy service, Jordan Kennedy. Jordan, welcome.
Thank you, Rebecca. It's great to be here this morning.
This morning, I will be asking Jordan various questions about the current and upcoming list, after which there will be a chance for attendees to ask any further questions. Please feel free to use the chat box on the right-hand side to raise any questions throughout the webinar. Before we begin, you will see we've added a poll to the right-hand side of the screen. Today, we are asking, if you are a business owner or occupier, have you had your business rates checked in the last 5 years? If I could ask you to take a moment to submit your answer, we will look at the results at the end of the webinar. Right, Jordan, I think it's important we start with a brief explanation on what business rates are.
Agreed. Thank you, Rebecca. So quite simply, business rates are a tax on the occupiers of land and the buildings that they occupy. So all commercial properties should have what we call a rateable value. And this is a figure which is used to inform the level of business rates an occupier or owner pays to the local council.
Okay, and what is rateable value?
Good question. So rateable value is an estimate of the open market rental value of a property on what is known as an antecedent valuation date, or AVD for short. This date falls exactly 2 years before the date of a revaluation. So to give that a bit of context, we are currently approaching the end of the 2017 rating list, with rateable values based on an antecedent valuation date of the 1st of April 2015. And the rateable value, or the open market rental value at the AVD, is estimated by the Valuation Office Agency, or VOA, and this is then used to generate an annual business rates liability for an occupier.
Okay, and how are business rates calculated?
So the rateable value is multiplied by a uniform base rate, or multiplier, and this figure, the multiplier, is determined each year by central government. So this tends to mean within each rating list, business rates rise ever so slightly at the start of each tax year, as the multipliers tend to increase based on the consumer price inflation figure from the previous September. This annual uplift has actually been cancelled, though, for the past 3 years in the wake of the COVID-19 pandemic, as the view was taken that this would offer occupiers stability when it was, of course, greatly needed. So this means that currently and next year, so from the 1st of April 2023, the small business multiplier remains at 49.9 pence in the pound, and the standard multiplier is 51.2 pence in the pound. Small businesses in this context are those with an RV rateable value below £51,000, and standard businesses are those with an rateable value, or RV, over £51,001. So just to summarise, business rates bills are calculated by multiplying the uniform base rate, or the multiplier, by the rateable value, and this leaves the annual rating liability less any reliefs that are applied to that liability.
Okay, so it's a significant cost for ratepayers, really,
Yes,
isn't it?
It can be, most definitely.
Are there any reliefs available?
Yes, I'm pleased to say there are. There's a few which I can run you through briefly, starting with the retail, leisure and hospitality relief, which was again a measure implemented by the government to support these occupiers throughout the COVID-19 pandemic and now beyond. So that currently provides eligible occupied retail, hospitality and leisure properties with a 50% relief. And this is up to a cash cap limit of £110,000 per business until the 31st of March 2023. And I'm glad to say from the 1st of April, this relief is actually increasing to 75% relief for 1 year, which is great news for many occupiers, as retail, leisure and hospitality does cover a very broad range of property types. Beyond the 31st of March next year. We don't know if that relief will be extended. It might be, it could stay the same. It might be reduced slightly. It might disappear. That will remain to be seen. Most likely be announced at the autumn budget this year, which is when the 75% relief was announced last year. Moving on, there is also small business rates relief available. And this applies if a property's rateable value is less than £15,000 and the business uses one property only. So where the rateable value is between 15,000 and 12,000, small business rates relief is applied on a sliding scale between 0 and 100%. Of course, the closer you get to £12,000, the closer to 100% relief you will receive. And therefore, where the rateable value is below 12,000, 100% small business rates relief should apply. As I say, that's usually only applicable if you have only one business property, but you may be eligible for this relief if you use more than one property, if certain criteria apply. And finally, we have empty property relief, which applies where people, landlords, occupiers, owners, find themselves with an empty property. So a office or retail unit, for example, after becoming vacant, would have 3 months empty property relief available. And industrial units, so warehouses or factories, if they become vacant, they would have 6 months empty property relief applied to their business rates bill. But after this time, most businesses then must revert to paying full business rates. There are some exceptions, such as listed buildings will remain eligible for empty property relief until they are reoccupied. But where these exceptions don't apply, it is possible to mitigate this liability by arranging temporary occupation of the vacant property. And this is something that Vickery Holman can advise on, where occupiers find themselves in that situation.
And you've had some great successes in that particular area, haven't you?
Yeah, we have. We've helped, I'm not even sure how many occupiers across the region with this, by arranging and facilitating that temporary occupation and communicating with the local councils on their behalf.
Brilliant. So the 2017 rating list is coming to an end. What does this mean for business owners?
Yes, so well, it means, as you say, the rating list is coming to an end. It's been a 6-year rating list, which is longer than it was originally intended to be. It was extended again due to COVID, but the fact that it's coming to an end means that a national revaluation, long awaited, many would say, is coming into force on the 1st of April 2023. So this means that time is running out for occupiers to appeal their 2017 rateable values, and potentially those occupiers could miss out on savings backdated to the 1st of April 2017. I can't stress enough how huge these savings can be in some cases. For example, Vickery Holman have, within this 2017 rating list, saved a car showroom occupier just shy of £190,000 in business rates payable, as we inspected the property, discovered a floor area discrepancy by measuring, inspecting, calculating the floor areas. We advised the client of this and negotiated an amendment to the property valuation directly with the valuation office agency. And this resulted in a change to the rateable value, or a reduction to the rateable value, and triggered this huge backdated saving of £190,000. Another example is we saved the owner of a dog training arena in Devon £65,000 over the life of the list, the 2017 list that is, by noticing that the rate per square metre the valuation office had applied was very high, completely out of line with dog training arenas nationwide, is where we drew our evidence for that, for this example. And we secured a reduction in the rate per square metre from £18 to £6. So that, of course, made a huge difference to that property owner from the start of the 2017 rating list throughout the list, and it will have an ongoing impact into the 2023 rating list as well, as the level the valuation starts at is an awful lot lower. And indeed, their valuation next year has remained at £6. So that was definitely a beneficial exercise for them. Same story with the car showroom. Their floor areas are now correct, so the future valuation will be based on the correct information rather than an inflated valuation from the get-go. And a final example, slightly different type of valuation, is that we saved the owner of a wedding venue £26,000 from the beginning of April 2017. And this was done by negotiating a reduction in the fair maintainable turnover figure that the valuation office had used in their valuation. This was done by analysing the client's accounts, again inspecting the property, and negotiating that reduction with the VOA. And without the somewhat unexpected reliefs that were caused or triggered by the COVID-19 pandemic and the government support, the saving would have been a lot greater for that client.
Jordan, these are no small savings, and some of our clients come to us speculatively in the hope that we can save them a bit of money on their business rates. But some of our clients are also experiencing real hardship, and these are significant sums that you're talking about here.
They can be vast, and I think it's so very important that people do have a look or consider having a professional look over them, because as you say, the savings are huge, and it's not in the example I've given here, but a good few of the businesses that we've helped over the course of this list have been close to closing down due to a wildly incorrect valuation, and the savings achieved then essentially have saved those businesses.
Yeah, brilliant. So going back a step, we've got the new rating list coming into effect on the 1st of April 2023. What is a revaluation?
Very good question, thank you. So rateable values, as I've been mentioning, do inform the business rates that we pay, and these rateable values are updated periodically by a revaluation, and this is intended to bring the business rates liabilities in line with market conditions. So as I've said, we're currently approaching the first revaluation in 6 years, which should mean that as of the 1st of April, all businesses have a new rateable value, which should reflect the market for those businesses in April of 2021. So it's, as I say, it's to bring rateable values more in line with the current economic climate.
Okay, and what does the revaluation mean for occupiers in the Southwest?
Well, there will be some that win, some that do see reductions in the Southwest, and there will be those that lose as well, unfortunately, from the 1st of April. So I've just got a little summary of the main property types and how they're going to be affected in the Southwest. So industrial properties overall are going to see a 27% increase to their rateable values, whereas office and retail premises are looking overall at 5% decreases, which is good news, brings those, certainly bringing retail more in line with where we would expect. Caravan parks and holiday parks, however, are going to see on average a 32% increase, and restaurants are looking at 17% increase, and car showrooms are looking at a 23% increase, whereas pubs are looking at a 4% decrease overall. And finally, self-catering holiday accommodation is looking at a 15% decrease overall. So yeah, a mixed bag, which is largely what we would have expected. But interestingly, the increases in the Southwest are actually higher than the national average, and the decreases are unfortunately slightly lower. And I've just got a bit of an example of how this might affect an occupier in real terms. So I've taken an industrial unit as an example, actually, at the 27% increase. So if a unit of this nature currently has a rateable value of 40,000, the new rateable value from the 1st of April will be 50,800. And this means in real terms, the actual annual business rates liability will increase from just under 20,000 to just over 25,000. So over the 3-year rating list to 2026, that is quite a difference to that occupier.
I think, as you say, mostly as expected. The industrial market's been strong, as we know, over the last few years, but perhaps a couple of surprises in there as well, with holiday lets generally decreasing on average.
Yes, that was a surprise, because they did, on the whole, extremely well in the season that the valuation office are looking at. But I suppose excellent news for those occupiers.
Absolutely. Okay, so is there anything that people need to know about the revaluation in particular?
I think what I really wanted people to get from today, and just to be aware of in general, is that it is coming into force on the 1st of April, and that people just are aware that it is possible to check their rateable values for accuracy, be it factual accuracy or otherwise, and to challenge the new values if they don't seem right, and just, to be aware that you're not necessarily stuck paying that if you think there's something that could be looked at, or if a professional could have a look and think there's something to be looked at for them.
Yeah. And is there any support out there for people whose rateable values are going up?
Yes, I'm pleased to say there is. So for those who are going up quite considerably, so industrial units, for example, as I mentioned, transitional relief should apply to those occupiers if their bill is going up by a certain amount. So transitional relief limits how much their bill can change each year as a result of the increase. And it also phases the changes to the bills in gradually. So councils will adjust bills automatically for those who are eligible, and will apply the transitional relief automatically to those bills. And as I said, the changes are phased in gradually due to transitional relief. So if we take an occupier with a rateable value between 20,000 and 100,000 as an example, if their bill is increasing, the increase will be phased in by 15% in year 1, 25% plus inflation in year 2, and 40% plus inflation in year 3. Those percentages are slightly different for occupiers with rateable value below 20,000 and those with a rateable value above 100,000. So I'm just giving the middle example there, but those figures can be found on the government website. And at the other end of the scale, there are many occupiers who would have been benefiting from small business rates relief during the 2017 rating list, which may be losing that due to an increase in their rateable value. So if your rateable value is going up slightly, just over 12 or just over £15,000, your small business rates relief could be affected from the 1st of April. But the government have introduced the Supporting Small Business Scheme, which will ensure that no bill goes up by more than £600 in the 2023 to 2024 tax year. But much like the retail, leisure and hospitality relief, we do not know yet if the small business support scheme will be extended beyond 2024. So we're not entirely sure what help will be out there after this year.
Okay. And what can people do if they want to check the accuracy of their rateable value?
Well, it can be quite a complex and time-consuming task. So I do think it's very much worthwhile instructing a professional to advise you, first of all, if they think there is anything that can be done, and also how it can be done, if indeed they discover something that there is there to look at. So I think I'll just talk you through what we would do when we carry out a business rates review to give people an idea of what's involved. So we would always start by inspecting the property. Offices, industrial units, and most shops are valued on a price per square metre basis. So the best place to start to check the accuracy of such premises is to measure the property in full to ensure that the floor area the valuation office are using to calculate the rateable value is correct. As I previously mentioned, savings can be made where it's found that the floor area used in the summary valuation is too high. This can be a particularly intricate process where shops and high street restaurants are concerned, as these are considered in what we call in terms of Zone A. This is a technique of valuation which applies a unit of rent to the zones of the area of a unit to carry out the rental valuation. And this is based on the principle that the most valuable area is to be found at the front of the shop, so the display area, and then that the value of that unit then decreases with the increasing depth of the unit. So if we find, which we have done in the past, an error in the calculation of the Zone A floor area, really quite considerable savings can be made just by arguing with the valuation office that should be in Zone C or considered in a different way. So yeah, that is a very useful exercise to carry out, but is quite specialised as well. So when we've carried out the floor area check, determined if there's anything to be done there, we then move on to considering the rate per square metre itself. And this is based on local rental evidence at the antecedent valuation date. So that would be, at the moment in the 2017 rating list, evidence in and around the 1st of April 2015. And when we've moved to the 2023 rating list, that will be evidence in and around the 1st of April 2021. So we would then carry out comparable evidence research to ensure the rate per square metre used in the valuation appears fair. As Vickery Holman have very active valuation and agency departments, our rating team have access to an excellent database of evidence, which we do use to inform our opinion of the accuracy of the rateable value. We do carry out additional research every time we take on a new job as well to ensure that we've covered all possible evidence. And if we do find that we feel the property has been overvalued, we then prepare a very well evidenced challenge document to be submitted to the valuation office on behalf of that occupier, which would include lease details of all the comparable evidence we've discovered, as well as anything else we can think of to support our argument, which could also include taking a look at the valuation scheme the property has been placed in by the valuation office, which the valuation office put all properties within valuation schemes which apply to their quality, locality, size, all manner of factors. And sometimes we find that they've simply placed the property in an incorrect scheme and that we can bring the value down slightly that way. Just want to touch on how we would look at the rateable values or negotiating a decrease in the rateable values of trading properties. So that could be a hotel, a pub, or a holiday park, for example, as these are looked at slightly differently. The valuation office look at these property types using the receipts and expenditure or profits method of valuation. And in this, the fair maintainable trade or turnover of the premises at the antecedent valuation date is established by the valuation office. And this is based on the actual turnover figures of that property and also of similar properties in the locality or in that valuation scheme. And a percentage is then applied to these turnover figures around the AVD, which reflects the quality and location of the property, amongst other things. And the percentage applied to this turnover figure then produces the rateable value. So this is something we can advise on, and we've also had a number of successes in appealing these types of valuation, one of which I mentioned earlier, actually, the wedding venue.
It's not straightforward, is it?
No,
I think
it's quite a lot to it.
Yeah, you mentioned two different valuation approaches there, having access to a comparable evidence database. It's really difficult for owners and occupiers to challenge their own assessments, isn't it?
It is, and I do think that's definitely where we come in, as we have access to various databases, and as you touched on again, the evidence database that we can draw on as well is really invaluable. Yeah.
Okay, so what are the timescales involved in appealing an assessment?
They can be quite lengthy. There's usually no deadline to submit or to begin an appeal. Excuse me. Other than at the moment, any check to the 2017 rating list must be started before the 31st of March. So when you've submitted a check, the valuation office have usually up to 12 weeks to come back to us or to you, but they can take up to 12 months in particularly complex cases. I rarely see it take quite as long as 12 months, but every now and then it does go over 12 weeks. And when they've come back to us around the 12-week mark, normally we then have 4 months to submit our challenge document to the VOA. And this is all done via the government gateway. And then they have 18 months from the date of the challenge submission to come back to us with a decision notice. So quite a lengthy process all in.
A difficult one and a lengthy one.
Yeah, it's not made particularly easy, so unfortunately.
No. And are there any deadlines that people need to be aware of?
No, other than the 31st of March this year, which hopefully I've stressed, just that any check would need to be in the system by that date. To be very clear, the challenge section of the process that follows after the check can start after the 31st of March. It's just beginning that process with the VO has to be done via the government gateway by that deadline.
Okay, thank you. Finally, any last minute tips?
Thank you. I suppose, at risk of repeating myself, I just want people to remember that there is just over 5 weeks to the end of this list, and there could be potential to secure backdated savings. Occupiers can look at their current and future valuations. This can be found at www.gov.uk/find business rates. And here people can look for themselves for the most part. So you can see which floor areas have been used. You can see how the property has been zoned in the case of retail units and high street restaurants. You can also see if the valuation office have included parking, air conditioning, plant and machinery, land, very many other things that can be included in summary evaluations. So people can have a look and see if anything looks obviously out. That's a really great place to start. And you can also see the rate per square metre there that's been applied and why or if your valuation is going up next year, or this next financial year, this April. If anything looks wrong, please just ask, and we're always happy to have a no obligations conversation to start with and see if people can challenge those valuations.
Brilliant. So really great advice there, Jordan. Thank you.
Thank you.
So this brings us to the end of our Q&A. Before we look at your questions, at the start of the webinar, we asked, have you had your business rates checked in the last 5 years? And Jordan, if you'd like to have a look at the results of today's poll.
I will. Thank you, Rebecca. I can see that I can't, sorry, it's actually just disappeared, unfortunately. Oh, here we are. Yes, so 4 have had their rates checked in the last 5 years. Excellent. No one doesn't think so, which is great. One person on the to-do list, so very happy to have a conversation, of course, about that one. And there's a few that said it's not applicable, so that's great as well. I'm glad the majority have had it done.
Brilliant. Okay, so if we revert to the chat box to have a look at the questions raised by you this morning.
Thank you. I will just scroll up to the top. Bear with me while I just read through these. So I'll start with Tim. Thank you for your question. You had your business rates realigned in 2017 and that adjusted the rates downwards. Will we need to re-challenge from the 1st of April? I would need to look at that individual case to comment with any absolute certainty, but I would also depends on the property type. I would hope it had followed through and informed the new valuation. But if this was an industrial unit, for example, and your rate per square metre was challenged and reduced in this current list, it may have gone up. It will have been put in a new valuation scheme for the 2023 rating list. So there may be room to challenge that again. Sorry, a bit of a vague answer potentially, but I think it really does depend. But Tim, please, I'll try and find your email address after this and contact you directly to see what I think of that one, depending on what the property is and the facts of that question. But thank you.
Okay, so Neil has asked, hello, I'm comfortable with my 2017 valuation, but not the 2023 valuation. When can I get a breakdown of this figure and challenge this one if necessary? Gov website suggests this can only be done after the 1st of April 2023.
Yes, I imagine this is a trading property, Neil. That is indeed the case. Unfortunately, the future valuations are only available for properties that are done on a price per square metre basis at the moment. So trading valuations, we have not been able to see on any client's behalf yet how those have been calculated. So when the 1st of April comes, you should be able to see your summary valuation, download that. And from that moment on, either receive some advice on whether or not you can challenge it or determine if you think you can challenge it in line of what your accounts submitted actually were. If it looks wildly out, then there may be some work to be done there. But yeah, it is correct that you can't see that yet, unfortunately.
Okay, so question from Simon as well. Support has been forthcoming, was during COVID's height, and still seems to be forthcoming for small business, with rateable value of 51k, which almost exclusively services the hospitality sector. Is there anything available which might help other than a review of rateable value, for which I see little mileage as it's not out of line? Unfortunately, I would say not that I know of. I agree that the support has been very much focused on properties in those sectors. So other than transitional relief, which delays, I suppose, the extent of how the rateable values are going to be felt and the business rates liabilities are going to be felt, that I know of, no, there's nothing on its way at the moment. But of course, this can change with each budget as and when new announcements are made. Yeah. It's a difficult one, isn't it? Simon, have you had your assessment reviewed? It'd be good to hear more from you on that. Tim has also responded actually to say, yes, we are. Thank you. We are a hotel insurer.
Yes, thank you, Tim. In which case, my answer shouldn't have been about an industrial unit, but it will depend on the figures that you and other hotel occupiers in Truro will have given to the valuation office when you submitted your form of return. So your fair maintainable turnover, which you'll be able to see from the 1st of April that they've based that on, should be in line with your accounts at that time and should be in line with the accounts of comparable properties in and around Truro. If it's not, then indeed you might need to challenge that again, yes.
Great. And then finally, a question from Austin. Oh, sorry, more questions coming in. Hi, Jordan. Should the rateable value for a service office be gross rent, i.e. inclusive of utilities and other services, or the net rent?
It would depend on, it should be the net rent, but I sometimes wonder how the valuation schemes are informed, because I don't think it's made that clear on the forms of return if people are submitting net rent or gross rent. But the answer is the rate per square meter should just be based on the net rent itself.
Yeah, brilliant. Emma has asked, hello, we have a small industrial building. Our rateable value is changing from 11,000 to 13,250. Having never paid anything, I'm really unsure how much we will now pay. You mentioned a £600 cap for small businesses.
I will be able to answer that question if I give it a little bit of thought, Emma. You should get, if that's your only business, which I presume it would have been if you've not been paying previously, you will get a discount as it's between 12,000 and 15,000 anyway. That discount will be calculated on a sliding scale. I can't do it off the top of my head, but I will contact you afterwards to give you an idea of how much you'll be looking to pay from next year. And the council will be issuing the first bills as well from soon after the 1st of April or just before, I believe.
Yeah, brilliant. And we have thanks coming in from Neil, Austin and Emma. Brilliant, thank you. Okay, so I think that finishes all the questions for this morning. Okay, brilliant. So this draws us to a close. Thank you for joining us today. We hope you found the webinar informative. And Jordan, thank you, of course, for your words of advice. If we can be of any help with any business rates related queries you may have, please do get in touch. And thank you for joining us this morning.
Thanks, Rebecca, and thank you, everyone.
Thank you.